between 800 to 1 million, 800,000 to 1 million new gym goers will enter the market. The challenge is how do we set about the expansion and the growth? How do we grow as a Leejam company? And the strategy to some extent has put a lot of focus around that. One of them is to improve our retention through providing a best customer experience in the market, regain our differentiation, and so many other things, and also leveraging our digital infrastructure and really use digital as one of the main pillars of growth going forward. So I don't want to speak a lot about our strategy, but definitely what we have gone through 2024 and 2025 was a great of use to us to really understand, like any other company, our issues, our challenges, how the market is changing, and how do we really position ourselves now and into the future. So with that, I'd like also to thank every one of you who attended the call. And with that, I would like to turn it over back to Mr. Yusuf. Thank you.
Thank you, Mr. Abdullah. I am now hand the call over to our CFO, Mr. Asim Al-Attas, who will take you through the presentation, starting with the key highlights. Mr. Asim.
Thank you, Mr. Abdullah. Thanks, Yusuf. Ramadan Mubarak, everyone. Jumping to the movement of centers we had during the year. As you know, we have opened 16 centers during the year, which is less than the guidance we have given at the beginning of the year, mostly driven by delays from the contractors as well as licensing. Moving to the number of members. Now the year-end number went down by around 3-4%, affected by seasonality, but the average number of members during the period grew by 10%, which is what we are always trying to improve as we open new centers. The split of year-end number between male and female, as we can see, there was a growth of 1% in the female, while a decline of 5% in the female centers, mostly driven by the operational issues we had, whether it's around road closures or parking, as well as definitely the seasonality impact. In terms of revenues, this is a fitness time only, just to draw to your attention in case you were comparing it with the financials. So 3% growth in terms of revenues for the fourth quarter comparing with last year. Gross profit stood at 186 million. This is a 5% growth. In terms of margins, a slight improvement in the gross profit margin, despite the openings that we had during the year. Likewise, for EBITDA margin, stood at 50% for the quarter, despite the openings we had. The drop in the net profit is mostly, if we exclude the one-offs, is mostly driven by finance costs and SG&A items. The same picture for the full year. Growth in revenue was around 8%. In terms of gross profit, this is the full year impact, where we had more pressure on the margin because of the openings and operational costs. EBITDA margin stood at 48% and the net profit at 20% compared with last year. As we can see, in terms of like-for-like centers, there is a slight decrease in terms of revenue, very minor decrease of around 1%, but that 1% shows you the operational leverage we have and the impact it has on our gross profit, EBITDA, as well as net profit margin. The good news, however, is that the non-like-for-like momentum is still on upward trend, whether it's on terms of revenues or margins. And that's again driven by the operational leverage we have. In terms of quarter view, in absolute terms, we are growing. In terms of per center outlook, the impact of the centers that were open during the period over the last, I would say, 24 months is still adding pressure, as well as the change in the product mix, as well as the brand mix. The same goes for the net profit absolute terms for the company. Our current ratio dropped because of the obviously the drop in the cash balance. As we know, Q3 is a high season for us. That's why the improvement in Q3 in terms of current ratio, and then normalized in Q4 to 0.7%. In terms of debt to equity, stabilized at 1.7. The debt balance grew, but likewise the company as well grew. So that's why we maintained the same ratio. In terms of return equity, most of the improvement is because of the share buyback program, which has a positive impact on the return on the equity. Return on capital employed will always be under pressure as we grow the lease footprint in the company. The cash flow has shown a strong signs during the year. The free cash flow is around 400 million, comparing with 195 last year. The cash from operations hasn't changed a lot, but most of the impact is because we've reached our, I would say, end point when it comes to the first strategy from 23 to 25. Which was fueled by investments in capex and center openings, and that has a very positive impact on our free cash flow. Borrowings went up as we keep growing our footprint, as well as obviously the share buyback program, which we utilized. In terms of lease payments, the number you see on the screen is the payment of the principal, but as you know, in a lease accounting, there is a portion in the finance cost paid. That's why the finance cost seems higher, but in reality, it includes the interest costs, the buy now, pay later, the lease portion, as well as IAS 19. And with that, we ended up the year with 171 million cash ending balance. In terms of free cash flow per center, as you can see, almost 81% increase as a result of that. Our cost of revenue grew by 4% in absolute terms. Per center level, we are still maintaining despite the inflationary environment. G&A, we saw a change in the mix, so we've showed more discipline in the general expenses, but we spent most of the saving in the advertising and marketing. There was a bigger competition, obviously, from all retailers, which we had to spend, especially on the online channels, to bring in sales volume. Pretty much the same outlook for the total year, with cost per center pretty much maintained, and growth in the absolute terms driven by the number of openings that we had during the year. We'll try to manage, say, SG&A as we move forward as a percentage to sales. Increase in cash is driven by the increase in debt. As you know, we maintained our dividends payout ratio comparing with historical, despite all the other programs that we have. Deferred revenue grew by 9% comparing with last year, with deferred revenue per center as well as member pretty much stable. This is the lease expiry over the next 5 years, with the number of expiries we will be having in terms of number of centers. We try to categorize it in terms of risk. We have 5 of them which we consider critical risk, and other 5 as high. The rest would be moderate and below. We also did an in-house assessment of the potential new rent. Again, this is subject to negotiations. But this is more of, to give you more visibility around what would be the impact based on the internal assessment if rents went up at the time of negotiations. But again, with the new regulations, I think we are more optimistic that not all of them will be materialized. This is more of a snapshot on the investments. As you know, we've impaired the investment with IMCS as well as Sports Hub. T-Sport, we've signed an agreement with private equity to inject money and grow this subsidiary. And Champs, we are still considering the options we have in mind. Now, as mentioned by the CEO, most of the growth in 26 will be driven by new center openings. We expect roughly 25 openings during the year, out of which 7 already opened during Q1 as of today. Obviously, there are opportunities to bring growth from price improvement as well as volume improvement as the market conditions improve, whether in like-for-like or non-like-for-like centers, which will be driven by a better customer experience and better customer retention down the road. In terms of deferred revenue, this is the outlook of deferred revenue as of December for the next 4 quarters. Q1, we don't expect big much of change comparing with last year, but going forward in Q2 and Q3, we expect a bigger portion of deferred revenue to be materialized during the year. Obviously, as well as the sales that will happen during the year. With that, we reached the end of the presentation, and we'll open it up for Q&A. Thank you.
Thank you, panelists. Ladies and gentlemen, we will now commence with the Q&A session. You raise your hand by pressing the hand icon at the bottom of your screen to speak with the panelists, or alternatively, you may drop your question onto the Q&A chat box. With that being said, we will, however, prioritize raise hands. Please limit your questions to 2 at a time so we may satisfy as many questions from participants as possible. You are, however, more than welcome to join the back of the queue if you have a follow-up. With that being said, the Q&A session is now open. Our first question today comes from the line of Mr. Abdullah Al-Buredi. Mr. Abdullah, we have unmuted you. Please go ahead with your question. We will move to Mr. Tahir Saifuddin. Mr. Tahir, all right, Mr.
Hello.
Abdullah is here. So please, Abdullah, go ahead with your question.
Hi, am I audible?
Yes, you are.
Yeah, thank you very much for the great presentation. This is Abdullah Brady from Emirates MBD Capital. I have 2 questions. The first one regarding the membership declines. As stated in the presentation, you mentioned it's due to road closures and parkings. However, we know that the network is vast for Fitness Time, and when there is an issue in one center, it should have been solved by having another one. And I mean, I drive in Riyadh, and I know road closure and parking is part of daily life. Would you think that the decline in membership is a result of the price increase that took place lately? For example, looking at the 12-month subscription, it is at 4,200, and I mean that is way higher than 1 year ago, and it is close to other players that are considered to be somewhat more premium compared to the Red Fitness Time or the Purple Fitness Time segment. That's the first question. Regarding the second question, we noticed that debt has increased despite that we're having only 25 expected openings. What's the reason for the debt drawdown?
Thank you, Abdullah. with regards to the first question, yes, the network is meant to serve all customers throughout the city, as you rightly mentioned. But I think traffic in main cities have also expanded, which would definitely impact in the decision of customers for renewals. Uh, in terms of competition, pricing hasn't changed since 2021, despite the inflationary environment, and we've increased pricing by 5% that got affected back in March. The competition also followed suit, and they've increased their price. And competition has been around. I think 5-minute drive from our centers historically. The nearest competitor is around 5-minute drive from our gyms. But we have a different positioning now. When in an inflationary environment, yes, some members could opt to go to a lower segment or a lower price tier. That's why we saw growth also in the Express, but we didn't see that much of cannibalization from our own members. It's hard to tell, for the whole network, where is the main driver. There are multiple reasons. Market is one. Inflation is two. Competition is also definitely resulting in that. So it's multiple reasons, and every center has its own factors. For example, we have Thamama Road, our main road here. 2 centers got affected with that closure. So it's not one theme across the whole network. Every center has its own challenges. Still, the decline in like-for-like is by around 1%. The issue is the operational leverage. Any drop in the revenue will affect straight away the bottom line. So that's really my take on the trouble.
So Abdullah, I think a few points that I also would like to add. Yes, end of year number of members have declined, but overall number of units has increased year in year. A lot of, when we talk about competition, we talk about new companies or new gyms being around us, and the clients always they want to have the option to go and check and see. And we've seen also some of our members coming back to fitness hub. Anyway, so this is happening in the past. I think looking forward to the strategy, one of our major focus would be is to ensure that we provide the best value for money. I think that's a hook from our side to ensure that our customers, regardless of what they pay, whether it's 5% increase or less, I think this is something that we can always debate. That we provide the best experience, the best personalized experience going forward. I think that's a focus that our strategy, inshallah, will put, and it will be followed, continuously. Back to you, Asim.
Thanks, Busara.
Management. Thank you, Mr. Tahir. Sorry, Mr. Abdullah. Next question comes from Mr. Tahir Saifuddin. Mr. Tahir, please unmute yourself and go ahead with your question.
Yes, good day, gents. It's Tahir from JP Morgan. Ramadan Kareem, and thank you very much for taking the time. Maybe 2 questions from my side. The first one is just trying to, get our heads around the overall picture. It's been 2 years of aggressive expansions, margins getting diluted, with the hope that potentially, we'll get to that 250 centers, and then from there, the business could actually stabilize, and then we'll see the P&L growth that we have been waiting for. So, from what I can see now, it's that openings in 25 came below guidance, and now next year is going to be, or 26 is going to be even busier in terms of new openings. At the same time, if I look at the LFL versus the non-LFL, it's a bit worrying, because the non-LFL on a gross margin seems to be a massive difference to the LFL. So I think the question that I have here, maybe for management, is how should we think about, margin trajectory going into 2026 after 2 years of dilution, knowing that you're still going to be busy with new openings? And does it make it even more difficult, maybe, Mr. Asim, that now the like for like is starting to, trend down? Because before you used to say like for like is still positive, low, mid single digit, keeps comfort. Now we're down 1%, and you know that more new gyms are going to open and the competition is not going to ease, right? Because peers are being very aggressive. So maybe just your thoughts overall as we go into 2026 based on all of this that I've mentioned.
Thank you, Tahir. I want to start with the margin piece. As you know, our business relies on operational leverage. You can see the difference in the revenue between the two segments, the like for like and the non like for like. The like for like is around 8 million, 8 point something, whereas the non like for like is pretty much half of it. So that's really the main reason for operational leverage. We talked about this a couple of times. Our contribution margin is pretty much 100%. Every sale goes straight to the bottom line. The moment the non-like-for-like centers materialize and mature similar or closer to the like-for-like levels, their margins will catch up eventually. In terms of openings, most of the growth in revenue that you saw over the last couple of years comes from the new centers that we opened. And as long as the market still has room, and this is obviously shown by the accelerated momentum of non-like-for-like sales, then we will keep opening, because this is what will fuel our growth going forward. But again, the performance varies from a location to another. We've opened the location in May 2025. It made 5 million of sales less than 1 year. It's not even like for like. So location is really the main driver for us to keep expansion, and it shows that there is big demand out there that we will go after. Now the question is, seasonality. I mean, I wouldn't say seasonality, but I mean, we had a drop in Q4, yes, but our metrics are pretty much positive. If I will think about retention, for example, which is not here on the slide, but our retention from Jan until December is at its best over the last 3 years. The renewal rate, precisely, the renewal rate of members. So the best in 25 versus 23 and 24. So we don't, I mean, is this a temporary, or is this going to be sustainable? It's not clear. This is something that we are always tracing and trying to watch out for.
Did we trough on the margin front, just simply as we go into 26? Is 25 the bottom in terms of margins, and we could start, growing from here? Or you think there's still more pain in terms of the margins as we open more centers?
Well, I think with the business plan that we're putting forward for the next 5 years, we expect the margin to stabilize 2026 and improve afterward. I think that's how we look into it. But 2020, I think we're reaching, inshallah, the bottom of the margin this year. It could maybe continue this year, but it will improve, inshallah, the years after, and which is exactly what we have also shared with investors in our face-to-face meetings and our calls back in 2025.
Sorry, just one ask, because in the presentation, sorry, I don't want to hijack the call, but in the previous presentations on the non-LFL, you used to include the EBITDA margin. And in FY, I can see now you're using the gross margin. it's a bit misleading because for us to see the operating leverage, we would rather have the EBITDA margin. If you can share these data with all people on the call, if that's okay, Mr. Azam.
Tahir, done. We will update the presentation for the EBITDA and upload it to the website afterwards.
Shukran. Thank you very much.
Thank you so much, the management and Mr. Tahir. I would now move on to some of the questions from the chat box. So, first question is from Mr. Abdul Rahman Alubakan. Can you shed some light on why COGS declined Q and Q despite 5 openings?
Can you repeat the question, Fahad?
Sure. Can you shed some light on why COGS declined Q and Q despite 5 openings? Cost of goods
I
sold
assume
declined Q and Q.
Yeah, I assume the question about cost per center, because absolutely it went up as we opened more clubs. Per center, it goes back to the center mix. That's one reason, and timing. So if more Express is opened, obviously it has a lower cost. That would have an impact on the blended cost. We always try to improve our cost as we go. So newer centers opened would have a lower construction cost per meter. We keep improving from that end. Our equipment mix also we started to diversify, which usually comes at a lower cost.
And we'll improve the customer experience as well, both sides. I think with that, I don't want to also to hijack what Asim is saying. Part of what we want to do right now is to ensure that we hear our customers. We've been hearing them very well in the last decades. However, I think now our strategy should be really focused around what our customer wants and how can we be to cater to their requirements and needs.
Also, thank you, Mr. Abdullah. Also, the cost of sale includes commissions, whether for salespeople or paid programs. So that's also part of it, as well as depending on the seasonality. Usually, summer would have a higher utility cost versus winter would have a lower utility cost. But in general, our cost is pretty much fixed in nature, aside from the variable we just talked about.
Thank you, management.
Thank you, management.
The second question comes from Abdul Rahman. He says, can you elaborate more on the lease expiry slide? What do you mean by critical, high, moderate, etc.?
Basically, critical means we still didn't reach. As you know, we try to renegotiate 3 or 4 years ahead. So the critical are the ones that we still didn't reach an agreement with the landlord in terms of renewal. The other ones are less risky in terms of renewal probability.
Miss Sarah asks, for Express format,
do you expect any
closure during
closure
2026?
during 2026?
No, we haven't closed any Express format. Express is doing very well for us. In terms of pricing, and this goes also to the aerial question from Abdullah. Before increasing our price, we conducted studies internally and with consultants to understand the perceived value versus how much customers are willing to pay. And the indications that we got from the surveys is that there is a headroom to increase the price. That's why we started with a 5% increase. However, the study included several increases down the road, which we opt to delay given the market conditions. Express has a huge opportunity, or the biggest opportunity in terms of price increase, given the value we give to customers and given the competition that we see in the market. But again, we don't see the urgency now to go for it.
Our second
Our
question
second question is, what will be driving
the
the volume growth in existing centers,
given the
high competition and potential cannibalization from new centers?
Good question. Overall, the industry is expected to grow. So we talk about penetration. The number of gyms per capita, for example, we believe it's a supply-driven demand. So the more gyms are there, the more demand will gonna come. So number of gyms per capita in Saudi is around 5 to 6 for every 100,000. In the developed markets, let's say the US, it's around 12 for every 100,000, despite all the other alternatives. So that's why there is room for increasing the number of centers. In terms of increasing the number of members per center, it goes back to penetration. The government is doing a lot in terms of pushing public to exercise and adopt healthier lifestyle. Gyms is one way of helping in doing that. That's why we believe. So from a capacity standpoint, our centers have room to capture more members. It's about the decision of customers and the choices they have, and allocation within the wallet, basically.
Thank you, management. Mr. Abdullah Al Salam asks, could you please provide an update on the subscription mix in 2025? And does the deferred revenue chart in the presentation indicate that the membership duration mix has lengthened?
So the product mix in terms of tenor pretty much stabilized during the year comparing with last year, but still we see a trend toward a longer, at the end of the day, the way we design the campaigns help in steering customers toward whatever product we try to sell. But it's pretty much in line with last year, with slight increase in 12 months package. So, and this would also definitely have an impact on revenue as well. So the 12 months package was around 30% roughly last year. It's 35 this year.
Thank you.
Thank you.
Next question from Mr. Abdul Rahman. Are you currently profitable in the express format? Are you planning any price increases for the segment given the data versus competitors?
Sorry, again, I didn't hear it.
Are you currently profitable in the express format?
Yes.
Are you planning any price increases for the segment?
And it's under discussion. We didn't yet decide it. We did the studies. We have indications that we have room, but we didn't, given the market conditions, we didn't yet implement it.
Our next question in the chat box is, can you please elaborate more on your plan in stabilizing margins in 2026 while the target to open 24? I think management, the mic is on mute. Can you mute yourself?
Yeah, thank you. So the margin goes back again to the number of members. As we mentioned before, the contribution margin for every new member is pretty much 100%. So the more members per center is there, the better is the margin. The margins currently, whether gross profit or EBITDA, across the whole network is not the same. Even though at the same segment or in the same gender. The reason is volume. Those centers which have higher volume than the average of the company has much higher gross profit and EBITDA margins than the rest of the company. And this goes back to the penetration in the areas we are present at, as well as the competition if it comes in those areas.
Thank you, management. Next question comes from Mr. Ankur Agarwal. Mr. Ankur, your line is unmuted. Please go ahead.
Am I audible, management?
Mr. Ankur, you're,
Mr. Ankur,
you're audible.
you're audible.
Anchor, can you repeat the question?
No, I've not
No,
started
no,
the
I have
question.
not
Thank you.
started the question. Thank you.
Hello,
Thanks.
Anchor, how are you?
Yeah,
All good, all good.
all
So
good,
my
all good.
question
So
really
my question really
is that
is
basically is this margin situation self-inflicted because you opened too many gyms, or is there a strong element of competition that is also affecting the margins and the ramp up of the newly opened gyms? That's my first question. My second question really is about the uh, fact that you were very optimistic about the fourth quarter in the third quarter earnings call, and you had given a very upbeat guidance about the prospects for 4Q. So, what really changed since the 3Q earnings call and now, which led to the miss both on revenue and margins? Those two questions, really, from my side.
Thank you, Anchor. On the first one, as you see, the non-like-for-like centers are still maturing. They have half of our blended revenue across the network. As those centers grow and mature, they will improve in terms of margin. That's pretty much the story here. And the same goes for like-for-like. If the like-for-like dips by 1 or 2%, as we saw on the slide, it will have an impact on the margin of those centers as well. On the guidance, and this, thanks for bringing it up, because this shows how the operational leverage have an impact. We had sales of around 360 million last year. I'm talking sales, not revenue, in the fourth quarter. We projected we will make sales of 380 million during the fourth quarter this year. It made sense given the momentum that we saw in the first 9 months, the number of openings we have, the momentum in the like-for-like, and so forth. What happened is that we missed by 7 million only for every month, like total 20 million for the quarter. That 20 million miss resulted in the bottom line miss we expected. That's really pretty much the case.
Oh,
We are talking
so
about
follow-up
7
question,
billion.
right?
Yeah, I was saying, so we are talking about 7 billion across the whole network every month. It's not really a big, amount, but it had an impact. Yeah, go ahead.
So, what are the
So
trends
what
you
are
are
the trends
seeing
you
in the
are seeing
first
in the
2 months
first 2 months
of this
of
quarter?
this quarter?
We saw mixed trends. Jan was strong comparing with last year. Feb is actually lower. So that's the challenge with our industry, the predictability. You are a lifestyle product. People make choices, and it has an impact on your business.
All right,
All right,
understood. I think
understood. I
all the
think
best.
all the best.
Thank you.
Due to the echo, I'll request management if you could mute yourself during the questions and then subsequently unmute yourself afterwards. Thank you. So I'll take a few questions from the chat box. Jawahar Saeed asks, who are the international and local competitors? Can you name some of them, and are they chains or individual businesses? Management, you can
I
unmute
mean,
yourself.
yeah, we have both competition from the non-branded segment. The non-branded is the single unit owners. Although the future outlook for this segment is that it will gonna shrink, with people going more for the institutional networks. International ones, we have mix of regional ones as well as global ones. But we also have some of the global ones that have exited the market. So it's really mixed between the two.
Thank you. I would just like to remind the participants that you raise your hand by pressing the hand icon at the bottom of your screen to speak with the panelists. Or alternatively, you may drop your question into the Q&A chat box. I'll take the next question from the Q&A chat box from Mr. Fawad Khan. Would it be possible to give color on the number of members post 2025 end? Is the company able to capture the decline in membership base? You can unmute yourself.
Um, Obviously, our members or numbers of members grew over the last 2 to 3 years. That's the overall trend. Actually doubled. I mean, if you think about 3 years back. Part of it is driven by the overall appetite of customers. Especially, we saw this in 23. There was a big jump because obviously after COVID, people were more health conscious, and we saw a big wave of customers joining. Now, as you go, we do expect the whole market will gonna grow, as mentioned by the CEO. The market is expected to reach 10% penetration by 2030. So, and this is a global trend, I believe. Overall, health conscious and healthier lifestyle is the theme locally, regionally, and globally. So, our centers, which are already in very good prime locations, should capture this as we grow. But again, given it's a lifestyle product, you could expect headwinds in certain seasons. And the number of members, as you know, is affected by the seasonality. Winter is a very low sales season, and accordingly, the number of members will be lower. People more into outdoors, and vice versa in the third quarter, second quarter, the second half of the year.
Thank you. Next question is from Kiran Thamanani. What is the reason, the JV with Burjeel, what is the reason for it not being a successful venture? Is it due to lack of demand or operational challenges or something else? Please, could you unmute yourself?
There was a business plan that we had in place for the business model, and the results were lower than what we expected. And that's really the main reason why it didn't work. So the model itself wasn't the right one. And that's the reason why we opted, we have a better usage of these spaces for our own business rather than for the physiotherapy.
Thank you, management.
Thank you, management.
Mr. Farid Aliani asks, what are your views about possibly slowing down the aggressive expansion plans to let the unit economics recover in a highly competitive environment?
Thanks for the question. Actually, it's worth bringing it up because we just finalized the strategy. It's not yet approved, but it's in the process. And as per the market research, um, as I mentioned before, and the CEO mentioned, the market is expected to grow, and most of the revenue growth that we saw over the last 3 years came from the new centers that we opened. So I think the strategy actually suggests that we keep growing our network. The numbers we have in mind is around 130 to 160 over the next 5 years.
Thank you, management. We do not have any questions in the chat box or any raised hands. We can wait for a few moments. If there are no further, we have a follow-up question from Mr. Tahir Saifuddin. Mr. Tahir, your line is unmuted. Please go ahead.
Yes, yes. Hi, gents. Am I audible?
Yes, you are audible.
Yes. Just a follow up on this, Mr. Asim. You said 130 to 150 new centers between over the next 5 years, starting 2026, included.
Yes, including 26. Again, this is the target. Given the growth in the expected in the market, it's not yet finalized. We are still in the process to finalize it and fine tune it and see which segments we'll be growing at. We are exploring studios, high-end studios that we will operate ourselves. We also considering the higher end segment. There will be a couple of them, and there will be a couple of a segment in between the middle class and the upper middle class.
So I just have a question. Why not? Sorry, I think
Yeah, we can hear you.
Yeah. So my question is really just in terms of the unit economics. I mean, ever since we started this very aggressive expansion plan, EBITDA margins have been getting diluted, and ideally we've been waiting, for these non-LFL centers to start, recovering so that they will play a catch up on the P&L. But now you're coming to the market and telling, everyone that, we're gonna be opening another 20-25, gyms per annum, as part of a new strategy, which ideally maybe could push or put even more pressure on the P&L. And I think the stock price has been reacting quite negatively for that. So I just want to understand, what is the rationale? Why not maybe scale back on the openings, ramp up these new gyms, because clearly their EBITDA margins are still below the group average, and then maybe think about ancillaries, other businesses, because also the capital allocation for you guys outside the gyms hasn't been that great, right? Because Champs failed, the physiotherapy is not working, T Sports is having a funding issue, and there's a PE player, Sports Hive. So maybe just taking a step back and looking at it, is it this right decision at this point, at least, to continue growing aggressively through that 130 to 150 centers, unless you have a very high conviction that the non-LFL centers are gonna play catch up, and then the EBITDA margin will stabilize and start growing, which I think at this point is very hard to justify. I don't know if I'm just making myself clear, maybe voicing some concerns here, but would appreciate your input.
Thanks, Tahir. No, valid inputs. I think the confusion is that we are comparing with the peak results which we had in 23, which, as I mentioned, this was a period where people came after COVID. They are more health conscious, concerned. We saw a big flood of members joining, which got observed within the existing network. So if you compare with that peak, yes, but if you go before that period, these are the margins that we used to have. And as a matter of fact, Q4 we had an EBITDA margin of 50. So again, and I'm not implying that this is the margin that we will see in the future, but this is the margin we try to always achieve as we grow and as we maintain our customers. We do believe that the number of centers we opened over the last couple of years is what drove the growth in the company, with like for like pretty much stabilizing and maturing, and we rely more on the increase in penetration. But if penetration didn't increase, you have current demand that is not yet fulfilled. And I've given an example of the center we opened during this year. So again, this is not a final number, but I thought of giving you a heads up of the early signs from the research that we've made. But again, it doesn't mean it's the same network, and we will be having a bigger network by then. So hopefully this will gonna help stabilizing as we move. But yes, the pressure is expected to continue if more centers are open and they take their time in ramping up, yes, maybe this is the new norm if this is the case. But
طيب, if
on
this is
the absolute
yeah,
terms, free cash flow terms, shareholder value terms, it is in absolute terms is much better.
طيب, if you're saying this pressure will continue, I mean, just judging by the stock price performance, I mean, clearly the market is not liking these numbers, and the last year and a half, Leejam stock has been under significant pressure. What kind of tools do you have maybe to reassure everyone on the call that there will be a P&L stabilization and then potentially a growth story, because you're talking quite positively on the market, and clearly your position and your scale is unmatched, there's no doubt about it, and the breadth of the offering that you have. But at the end of the day, when we look at the P&L and the profitability, we're not there yet, and clearly it's been a quite a tough story. So I just want to maybe get your views. What kind of levers can you pull for to restore that P&L growth that we've seen pre 2025 and 2024?
Again, the operational leverage nature of our business really plays a big role in the margins that we're gonna see down the road. Internally, the targets we put and the budgets we have every year is to have a better margin as we go, but there are market dynamics that affect the business at the end of the day. We are assessing now the impact on those new centers that will be opened on the margin, and we'll be able to give you a picture on the expected outlook of those centers as we move. Again, if those approved, it doesn't mean that it's a fixed target that we'll be opening it regardless of the other outcomes. We will be assessing the market year on year, but we want to open these centers to maintain our market leadership position, which will allow us to sustain these profits as we go. But at the moment, it's difficult to assess. We are in the process of assessing the final, the impact on those margins, and we'll let you know.
Thank you, management. I would request the remaining attendees to please limit to one question in the essence of time. I'm unmuting Mr. Jonathan. Please go ahead and kindly limit to one question. Yes, Mr. Jonathan.
Hello, can you hear me now? Okay. Hello.
Yes, we can hear you. Please go ahead.
Okay, perfect. Who's the consultant who came up with this assessment that you can add another 160 gyms? I mean, who was it? What's their background? Did they account for the size of the gym? Just out of curiosity, because this doesn't seem to track with what we're seeing right now and the additional competition we're seeing. And have you already paid them? Have you considered paying them in shares? Maybe if they have more skin in the game, they come up with a different analysis. Thanks.
Thanks, Jonathan. This is based on the market share assessment of the branded as well as the non-branded gyms and the expected growth trajectory in the market. It's one of the well-known names, and we assess this along with them. And as you mentioned, so we wait for the market, for the competition to come, or we go and capture. That's a dilemma. If we wait for the existing centers, we should expect competition to come, or we capture demand in the newer, the underserved parts of the kingdom.
Now we're taking the last question from Mr. Asmar. Please limit yourself to one question in essence of time. Thank you.
Yes, hi. Just Asma here from BSF Capital. Just one question from my side on your pre-sales strategy. I mean, considering that you're adding around 15% of your portfolio every year, and even going forward, that's what you seem to have communicated. Have you amended your pre-sales strategy? Because currently, as per your guidelines, the centers are taking on average 18 to 24 months to ramp up. So any work over there, have you slightly amended the pre-sale strategy to try to bring these ramp-up times to under a year or so? Because like you mentioned, your contribution margins are pretty much close to 100%, so you just need to secure as many members as possible upon launch. So any work over there that you have done or have experienced any changes on that front for the later openings that you've done probably in the second half of 2025? Thank you.
Thank you. Yes, the sales of the newer centers is higher than similar centers previously. This is because of the tactics we've been implementing to bring in more sales sooner, whether it's extending the opening discounts, whether it's extending uh, uh, the pre-sale campaign a few months before opening. Also, the site selection, we are trying to be more scientific about it to make sure we pick the right locations and sizing as well. So all these are being done to make sure we bring sales sooner. But again, we operate in a very low penetrated market. So uh, going to the gym is not a regular thing or part of the lifestyle of the population. I would ask people who go to the gym on this call to raise their hands, and let's take a take a poll on that. So, but again, um, we do all those tactics to make sure we maintain and improve our margins going forward.
Fahad, if we can get, I think Nu'man is raising his hand. If he is finished, then we can get the last question from the chat, just to give them more chances.
All right, so we can spend for a few minutes. All right, Mr. Naman Khan, your line is open. Please go ahead with your questions. Again, please limit to one question in essence of time. Thank you.
Thank you very much. I do believe that this was a tough quarter for you, and we do believe that there are tailwinds for the sector to grow further as well. But just as ballpark numbers, do you have any numbers how much the total fitness industry size have grown in 2025-24 versus the last year as well? So if you can just talk about broadly about the overall industry size, how big have grown, and do you have any numbers on that?
Yes, the market is expected to grow by 8 to 10% over the next 5 years. And that's why we wanted to capture a piece of that growth as we move forward.
And do you think how much market have grown in 2025, if you have any numbers for that?
Sorry, again, 25?
Yeah.
Yeah.
Specifically.
The size of the market, or?
Yes, size of the
Yes, size
market
the
and how
market
much
and how much
it grew.
Now, unfortunately, only 3 players are listed where we can see the numbers. 60 to 70% of the markets are non-branded, which are the single unit owners. The remaining 30% are the branded ones, which includes us and the other companies. So it's a very high level estimate of 7 billion, if I recall the as per the latest information we have.
Thank you.
Thank you.
That's all
That's
from my
all
side.
from my side.
Thank you.
I'll be taking the last question from the chat box. Would you be able to shed additional light on weaker Q4 performance, as the quarter is generally one of the strongest in terms of sales and profitability? When should we expect recovery to take place? From Mr. Sara Al-Bassam. Please unmute yourself. Management, can you please unmute yourself?
Yes. So sales grew by 13% during 2025. Revenue was lower at 8%, which is driven by the product mix as well as the brand mix impact.
Thank you. That marked the final question of our session to conclude our call. We still have some questions that request them to kindly write to the IR. And on behalf of Al Jazeera Capital, I would like to thank the management of Leejam sincerely and esteemed guests for taking their time for the call. Mr. Yusuf, the floor is yours for any closing remarks. Thank you.
Thank you everyone for your questions and for joining us today. For any additional or follow-up questions, please feel free to reach us out through the investor relations email, and we will follow up as soon as possible. This concludes the Leejam Sports Company Q4 earnings call. Thank you and have a great day.
Thank you, everyone. The meeting is now over and you may exit the call.